Let's welcome in DoubleLine Capital's CEO, CIO, and founder, Jeffrey Gundlach. It is a CNBC exclusive. Welcome back. It's nice to see you in this new year.
Yeah, good to see you, Scott. Nice to be here again.
You said on social media leading in that this was the most predictable, quote, no change in years meeting. What do you make, though, of what you heard? The market seems to have taken this at least a bit hawkish. Is that your takeaway as well?
Yeah, it's a little on the hawkish side, I think. I mean, the words of this press conference are, you actually nailed it in your intro, Scott. It's no hurry. We're not in any hurry to cut rates. And that's appropriate, I think. We've had a range-bound interest rate market for some time now, and the two-year Treasury is about 4.25% or 4.2%, and the Fed funds rate is at 4 3/8, so they're very much in sync. So I heard a very wide-open view of what the next move might be. No hurry to cut rates. Doesn't seem to be there's any inclination to raise rates at this point in time. And he's obviously focused on the stability in the unemployment rate right now in terms of not feeling a need to cut rates. The inflation rate has been drifting higher by a little bit. I mean, the CPI is up in the high 2s, and it was down in the mid 2s. And with the commodity complex being above its 200-day moving average on the Bloomberg Commodity Index, and looks like it may have bottomed out, and the price of oil is in the low 70s, and Trump wants to get the price of oil down, so he says, drill, baby, drill. But the price of oil hasn't changed very much. It's still somewhat elevated. So what's really fascinating is since the first Fed rate cut back in September, the two-year Treasury yield is up by 60 basis points. The 10-year Treasury yield is up by 85 basis points. The long bond ETF is down on price only, forgetting about the coupon. It's down by about 11%. So we have had this very unusual move that with the Fed beginning a cutting cycle, we have not seen a bond rally. In fact, the general high-quality bond market hasn't made much progress. So I think no hurry, and we're very, very data dependent. It seems like a new high has been reached in data dependency. And I worry a little bit, as I have periodically since the hiking cycle started and now the cutting cycle. I worry that we're running into a high degree of short-termism, that we're going to wait and see what the data does in just a few months ahead is what I think we're looking at. But I think market participants' takeaway from this is the Fed is on hold, and they're just going to wait for data. And so what came out of this meeting was completely expected and not a lot of insight on where we're headed other than data dependency.
I feel like we might have gotten some insight, if nothing else, into the psyche of the Fed chair when he said policy is, quote, well-positioned. I mean, I think he made the case that they think they're in a really good place and they can afford to not be in a hurry, as he said. You agree with that, or do you call that into a little bit of question?
I think when he says we're in a really good place in terms of policy and the economy, he's basically saying we're on hold. And yet, contradicting that, he says we're above the neutral rate. So the implication is that we're on hold until the inflation rate goes down. And unfortunately, it's probably not going to go down very much in the several months ahead. So I wouldn't be looking for rate cuts at the next meeting. Certainly, we didn't expect one in this meeting. And so we have a relatively stable place where we're standing. And it kind of supports the fact that the market is in a calm position right now, and so is Jay Powell, apparently. There are some things that are troubling, though, regarding markets. I notice how high the CAPE ratio is on the S&P 500. It's up in the mid-30s. It's interesting that when Ronald Reagan took office, the CAPE ratio was down at about 10. And so now it's about 4 times higher, or 8 times higher anyway, than it was when Reagan took office. So it doesn't seem there's any room for valuations to expand. And so it's an entirely earnings-driven market. We're going to have to see how that develops. At the same time, the credit markets are very, very low incremental yield versus treasuries. This has been a theme that's been developing now for a year and a half. And there's not a lot of room for error. And in fact, some things have happened, if you get a little bit down in the weeds, that are somewhat disconcerting, because they're reminiscent of what was going on in the mid-00s heading into the global financial crisis about 20 years ago. And that is that we're starting to see retranching of credit risk. You remember it was the credit ratings that screwed everything up in the subprime market back in 2007 or so. Well, now we're starting to see in the resecuritization markets of bank loans, which is called the CLO market, what we're starting to see is retranching of traditional letter ratings. So, for example, there's triple B rated bonds, and all of a sudden they're retranching them into senior triple Bs and junior triple Bs. Why are they doing that? They're doing that because the average interest rate that's paid by tranching it into two pieces is lower than the interest rate if it was just a triple B. And this is a slippery slope. It's only getting started now. I don't think that it's an imminent problem. One thing I've learned in over 40 years of the investment business is you might be seeing signs that are worth taking note of, but by the time that they really develop into a consequence, it takes much longer than you think. So in the subprime crisis, the retranching stuff and the nutty activity got started in 05 and into 06, but it wasn't until 07 that it really blew up. So I'm not really looking for this to be a problem in the first half of 2025, but something that bears watching, because once you start making AAA rated securities out of triple B rated securities, which is what actually happened in the subprime nuttiness, that's not happening right now, but it is a slippery slope, something to watch out for. So we're getting more and more concerned about the levels of valuation on the lower tiers of credit. I've talked about this in the past Fed meeting day appearances, but it's getting worse. It's getting more overvalued, and there's these activities of retranching are they're dangerous over a multi-quarter time frame. So I think investors need to be upgrading across the board in terms of reducing risk and upgrading across the board based on valuation. And the Fed's on hold, and they're not really in any hurry, as Jay Powell said, to cut. So you're not going to get any relief from interest rates, and you're not going to get any relief from valuation, because valuations on stocks are very, very high versus their own history, and the valuations on non-Treasury bonds versus Treasury bonds are very, very high based on their own internal history. So this is a time to be careful.
Did think it was interesting that when the chair was asked about financial conditions related to the stock market, he said that asset prices are elevated by many metrics right now. Now, he was, and I think he made the point pretty clearly, that he was zeroed in on parts of tech and the AI related stuff, but maybe not overall. So I understand what you're saying. Last time you were on with me, you said, quote, 2 cuts are on the maximum side for 2025. Given the fact that you believe today was, maybe putting in Sharpie, if you will, that they're on hold for the foreseeable future, 2 cuts, does that still make sense to you for the balance of 2025?
I would say exactly what I said in December, and that is maximum 2 cuts this year. And when I mean maximum, I'm not predicting 2 cuts. I just think that's the most you can possibly think about. And at the present moment, if you had made me pick a number, I would say now 1 cut would be the base case, and maximum 2, though, still.
Isn't that pretty good? I mean, wouldn't that be a good thing if the Fed doesn't have to cut as much as it might have thought initially, and that investors have come to grips with that fact? As Chair Powell said, as I told you what he said about where the economy is and the labor market, he thinks they're in pretty good balance right now.
Yeah, well, the unemployment rate went up for consecutive months, several months. It went up, and now it ticked down. And I think in the most recent reading, and I think he's taking a lot of solace from that movement. He was worried about the labor market weakening, and so the Fed's goals were in something of a tension. I mean, the CPI, or the year-over-year inflation rate, which he referenced today, that you use year-over-year. I thought that was important. He mentioned that it takes out some of the noise of seasonality. But it's a departure from where we were 18 months ago when we were talking about annualizing short-term inflation numbers. So he's looking more at year-over-year inflation. I do think that the unemployment rate being at 4.1 and having relaxed a little bit, I think that unless the unemployment rate starts going up, there's going to be it's going to be a slow process to get to a hurdle to cut rates again. And as I said just a few minutes ago, I don't think that you're going to see a cut at the next Fed meeting. So when the Fed says we're in a good place, he means the policy, he believes, or he chooses to believe, that it's going to lead to the unemployment rate staying at a comfortable level, a relatively low level, and the inflation rate, he's hoping that it comes down. I don't really understand. They mention owner's equivalent rent or the shelter component, and yes, that should come down. I don't know how much Southern California is going to factor into that because there's obviously not going to be home price declines for new construction or for rentals and so forth in Southern California. But I think it is good that the Fed's on hold, and it's because you need the Fed to be on hold or being easing to support the valuation levels that we have.
Jeffrey, I'll bring you back in. In terms of inflation, it was the chair who said, quote, "We seem to be set up for further progress." And in fact, recent reads on inflation were more calming. I think we could agree. Do you think we've seen the peak in the backup in rates that we witnessed from the cut that we sat together on, the very first one, that jumbo cut? Then rates backed up. We both sort of looked at the screen and were like, whoa, that's interesting. And they continued their march, certainly the 10-year towards 5%. It felt like it was going to get there, but then they backed off of late. Had rates peaked?
I think that rates have not peaked on the long end. I think rates will have another move up on the long end. It is interesting that the chair says, that we've cut rates by 100 basis points, and that's true on the Fed funds rate. But the 10-year Treasury rate is up by 80 basis points since that first cut. So mortgage rates, which price off the 10-year Treasury, had relaxed a little bit, and so housing got a little bit of improvement. But rates are back up to about 7% on 30-year mortgages. And I think the longer they stay at that level, the shock of, people remember the 3% mortgage rates, and then all of a sudden they were 7%, and that's kind of a shock. But now they've been up at 7% for around 7% for really a year and a half. And so, but I think that the budget deficit problem is primarily responsible, I think, for this backup in long rates, even though the Fed's cutting interest rates. This is by far the worst performance of the 10-year during a Fed cutting cycle. Usually bonds rally when the Fed starts cutting rates, but that didn't happen at all. In fact, rates went up. So I think that inflation is not going to easily go back down to 2%. We're well above 2%. I mean, we're at 2.9 on the core CPI, and or 2.6 or 2.7 on the headline. I mean, we got to get below 2.5, I think, to talk about putting rate cuts back on the table. And Chair Powell was quite clear in stating that we don't need to see a 2.00 inflation number, and I think he uses the PCE primarily, but we don't need to see 2% to talk about cutting rates. It's almost like it's the direction of the CPI, and right now the direction of the CPI is sideways, and he needs it to start coming down. I see that the owner's equivalent rent can filter through. There is merit to that idea, but I don't really see it from the commodity complex. And we'll see what happens with tariffs. So there's a lot of uncertainty, and for that reason, I think we're only 6 days or 8 days, whatever it is, into the administration. For that reason, I think the Fed being on hold, corroborating with the Fed funds rate totally corroborated by the 2-year Treasury, it's appropriate the Fed's on hold, and so this was a inconsequential meeting versus expectations. A little bit of hawkishness with that no hurry language, but he was a good three-handed economist. On the one hand, on the other hand, on the other hand, and it's a wait-and-see situation.
Given your view of the deficit and certainly the longer end of the yield curve, is that why is it a fact that you still like intermediate dated bonds, nothing longer than the 10-year like you told me before?
Yeah, we still believe that the yield curve continues to steepen. Irregularly, of course, but we were negative 108. The 2-year Treasury was 108 basis points above the 10-year back in last summer, and now it's at 34 basis points positive. We've had a huge swing on that, and I think it has a lot to do with supply problems, and I don't believe that the deficit is going to improve under the Trump administration. You can find, $50 million here and $6 million there through something called, the Doge thing, or the dog E as I call it, but I don't think you're with looking at some tax cuts and forever spending on wars and and natural disasters and all this stuff, I don't think the deficit's going to go down under Trump. And that's going to be a problem with the Fed on hold. And now the bonds that were rolling off from 5 years ago with coupons of 0.5% or 1%, it looks like they're going to be solidly in the 4.25% to maybe 5.25% range when those bonds roll over, and there's a lot of them coming up. So the long end, I would continue to avoid it. I like the intermediate part of the market. It's not nearly as attractive as it was 18 months ago. Spreads are much tighter on credit products. The Treasury rates are lower than 18 months ago. But when you take a look at the inflation rate, even if it's at 2.5% to 3%, you have a real rate of return from fixed income. I think you should always have a real rate of return from fixed income. We've lived through so many years of repression of interest rates that we had zero or negative interest rates versus the inflation rate for a long time. We should always have a term premium in bonds, and we have one now. So bonds aren't all that risky, but I do think that under the fiscal situation that we will likely see another move up in the 10-year Treasury yield.
Everybody, obviously, you, me, every investor, the Fed chair himself, as he made it clear today, trying to figure out what the impact on the economy and inflation tariffs are going to have. The proposed Commerce Secretary, Jeffrey, Howard Lutnick, said today on Capitol Hill that it's, quote, nonsense that tariffs are inflationary. What do you think?
Well, he's got an example to point to. It's a sample set of one, but the last time the tariffs came through, we did not have an inflation problem. Back under the first Trump administration, there were tariffs, and inflation did not stir whatsoever. So I'm open-minded on the idea that tariffs do not have to have an inflationary impact. But first, we have to see what the tariffs are going to look like. And there's an awful lot of saber rattling going on with the tariffs. If you do something that the president doesn't like, it's instantly tariff talk. And I don't know, I don't think that's really healthy as a one-tool reaction to all policy programs. You know, if you have a hammer, every problem looks like a nail. And if you're a tariff guy and you're going to respond to policies of foreign countries that you don't like and you're just constantly going to tariffs, I don't know. I think the effect of that will incrementally wear off. But we'll wait and see what the tariffs look like, and they need not be inflationary.
You have argued against the renewal of the tax cuts. I've asked you about that on several occasions. You've been pretty unwavering on that. Is that still your view today?
Yes, I want the budget deficit to shrink, and you're not going to do that by more tax cuts. So I don't really like the SALT thing in the tax cuts. I think it's really kind of absurd that was put on way back in the first Trump administration. That one I'd like to see go away, but otherwise the tax cuts, I don't want to see tax cuts. I want to see spending cuts. And I don't know if we're going to get that. Certainly history has not given you confidence that talk of reducing spending was going to result in a reality of cutting spending. But we shall see. Trump was a deficit spender in his first term, and I don't see any indications that that's going to change. And that's why I caution against high-risk positions right now, because I think long-term interest rates can go up, and valuations, as I said at the outset, are very high on credit in the bond market and on, obviously, parts of the equity market. So I'm favoring, again, equal-weighted equity exposure rather than market-weighted. That seems to have started to work. And I think fading the trends of growth versus value and small cap versus large cap, equal weighted versus market weighted, I think those got very extended during 2024, and I would not want to be betting on just a momentum trade that continues. So I like equal weighted in the S&P. I continue to like cash because Fed's not going to cut rates. Bonds on the shorter end to intermediate range, the price off of Fed on hold will continue to deliver. You can get 6% fairly easily. It's not going to make you rich, but it's a real rate of return of more than 3%. And I think you can live to fight another day when you get cheaper valuations in both stocks and credit bonds.
On that note, has what I like to refer to as the Gundlach model portfolio changed in any way? You like cash. You said last time 30% cash, 50% short-term bonds, 20% in U.S. stocks. That still sound right given what we know today?
That's about right. I might change something, in '05 here or there, but broadly speaking, that's the right parameter. About half money in relatively, middle credit to upper credit bonds in the shorter, to the 5-year area, 3-year area of the yield curve. I don't like stocks at these valuations, and I would still maintain maybe some of that cash you might want to hold in a real asset, perhaps a commodity fund, which seems to be showing signs of life. And gold, I think, has another move high as well, although it is near the all-time highs. But I still think dollar cost averaging into gold makes sense in this uncertain geopolitical environment.
Sure. Before I let you go, Jeffrey, I know, and we've talked before, and I could see from some of your social media posts that you're out in the Palisades, right. And it's really hard to comprehend those pictures, especially 3,000 miles away. Here in New York for many. I just wanted to say we wish you well, everybody out there, our hearts with everybody. Just a terrible situation that's going to take a long time to recover from.
It's much worse than anybody realizes in terms of the disorganization. There's nobody in charge. There was no preparation. And nobody knows what rebuilding is supposed to look like or how it's going to be organized. But I was spared. I was evacuated for 3 weeks, but I was able to get back this week. And I had some damage to my property, but fortunately my house inside is completely intact. If you go through the neighborhood, it truly does look like the pictures you saw of Dresden from World War II. And all that's left in most houses is a bunch of powder on the ground and a chimney. And the chimneys are evocative of a tombstone. And there's an awful lot of them, thousands and thousands of them. It's absolutely brutal to go through the neighborhood. And it's not going to be a short period of time. It's going to be years and years before this gets to some level of stability and livability. So thank you for the thoughts, and lots of people dislocated. I've had quite a few employees have their houses burned to the ground.
Yeah, it's hard to process all of it. We wish you and everybody well. We'll see you next time, Jeffrey. Thank you.
Okay, thanks, Judge. We'll see you next time. Good luck, everybody.
You bet. Yeah, that's Jeffrey Gundlach.